Global gas demand is accelerating, yet trillions of cubic feet of reserves sit trapped beneath the ocean floor, too remote to access through conventional pipelines. Traditionally, bringing offshore gas to market requires building a land-based liquefaction terminal. That means acquiring coastal real estate, pouring billions into concrete and steel, and enduring a construction process that can stall for up to a decade. Golar LNG bypasses the coastline entirely. They operate as the only proven independent provider of floating liquefied natural gas, or FLNG, as a service. Instead of piping gas to shore, a specialized vessel anchors directly over the offshore reserve. It extracts the raw gas, cools it to -260 degrees Fahrenheit to convert it into a liquid, and stores it in specialized cargo tanks for immediate export. Because the entire liquefaction plant is a ship, it can go wherever the gas is. If a field depletes or if global market conditions shift, this multi-billion-dollar infrastructure can simply pull up its anchors and sail from West Africa to Argentina. By collapsing the deployment timeline and erasing the geographic constraints of traditional LNG, Golar has positioned itself as the exclusive gatekeeper for nations trying to rapidly monetize their offshore energy. Golar does not actually own the gas they process. Their primary business model is liquefaction as a service. They act as a processor, charging resource owners a strict fee for every unit of gas that passes through their hull. This chart illustrates the foundation of their contracts, the base tolling rate. This structure guarantees a steady stream of contracted cash flow, largely insulated from the daily swings of global commodity prices. But the agreements also contain a built-in multiplier. In their Argentine contracts, for example, the agreement sets a baseline reference price of $8 per million British thermal units. When global gas prices rise above that $8 mark, Golar captures a percentage of the excess. For their MKII unit alone, every $1 increase above the benchmark adds roughly $40 million in pure profit to Golar's balance sheet. This structure heavily rewards operational efficiency. In the first quarter of 2026, their FLNG Gimme unit processed 19% more volume than its contract required, mechanically increasing the revenue generated for that period. A base fee protects the downside, while production bonuses and price-linked tariffs capture the upside. The company fundamentally operates physical infrastructure, but its overall earnings profile acts like a leveraged bet on global energy demand. Golar reported an adjusted EBITDA of $127 million in the second quarter of 2026. That quarterly income is supported by a massive contractual foundation. The company currently holds a $17 billion revenue backlog that stretches over 2 decades. Management expects this to compound rapidly. As new ships come online and existing contracts scale, they project an $800 million annual EBITDA run rate by 2028. This scale graphic visualizes the heavy capital requirement of offshore infrastructure. Building a single new FLNG unit costs over $2 billion to convert, requiring heavy borrowing and tight cash management to execute. Golar maintains a debt-to-EBITDA ratio of roughly 3.4x, holding $1.7 billion in net debt against $1 billion in total cash, using that $17 billion contract backlog to counterbalance the risk. This combination, heavy debt secured by decades of guaranteed cash flow, acts as a financial lever. If they execute, long-term shareholder returns multiply. If construction stalls or contracts fail, the debt weight quickly becomes a severe liability. The global energy markets are actively reorganizing. Nations are urgently trying to secure energy independence and diversify their supply chains away from traditional pipeline networks in Russia and the Middle East. Golar recently capitalized on this demand by ordering a 4th FLNG unit. Slated for delivery by the end of 2029, it will be the earliest available floating liquefaction capacity on the global market. However, delivering a vessel of this scale by 2029 means navigating a severely strained global supply chain. Offshore shipyards are currently battling intense inflation and long delays for critical components. Paying for these megaprojects requires securing specialized asset-level debt. Golar has to negotiate complex, multi-year financing agreements with syndicates of commercial banks and international export credit agencies to fund the construction. The market is demanding more offshore liquefaction capacity, But the extreme capital intensity required to build a fleet of these ships forces Golar to a critical financial threshold. In response to this threshold, Golar hired Goldman Sachs to evaluate strategic alternatives. The options on the table include a total sale of the company, a merger, or divesting assets. From a pessimistic view, the capital intensity of building multi-billion-dollar ships and absorbing shipyard delays is simply too high for a mid-sized independent company. In this scenario, Golar needs a larger buyer with a massive balance sheet to absorb the construction debt. From an optimistic view, Golar holds a monopoly position with a $17 billion contract backlog. They have the leverage to remain independent and distribute massive shareholder returns, or to dictate the exact terms of a highly lucrative merger on their own timeline. Will Golar execute their growth independently, merge with a giant, or sell off the fleet entirely? Let us know in the comments. This video is for educational purposes only and does not constitute financial advice. Always do your own research.